Hello everyone, welcome to another video. Let's talk about this strategy. Now, volume spread analysis. Make sure you read the book Master the Markets mentioned in lesson 1 before using our strategies. That's very important. You have to read that book Master the Markets by Tom William, and then you come to this topic and this strategy. That will be better for you. Volume spread analysis. I will share with you my first trading strategy. You can apply this strategy on gold, especially on gold, and you can apply this strategy on pound USD. You can apply this strategy on GBP USD, Euro USD, AUD USD, USD JPY, USD CAD, New Zealand USD, and also you can apply this strategy on BTC, Bitcoin, and oil, and few other instruments. But these instruments which I included here, you can apply this strategy on these instruments. Now, if you are trading in Asian session, then you have to use the time frame 1 minute and 5 minutes. Okay, on this strategy, if you are trading in Asian session, you have to use the chart time frame 1 minute and 5 minutes. If you are trading in the UK session, then you can use the chart time frame 5 minutes and 15 minutes. If you are trading in US session, then you can use time frame of 15 minutes, 30 minutes, or 1H. That's it. That's very clear. If you are trading in Asian session, you should use chart time frame 1 minute and 5 minute chart time frame. If you are in a UK session, you are trading in a UK session. If you are looking to trade in a UK session, then you should use 5 minute time frame chart or 15 minute time frame chart. If you are using US session, if you are trading in US session, then you have to use 15 minute chart, 30 minute chart, 1 hourly chart. Never go in 1 minute and 5 minute chart when you are trading in US session. That's very important. Now, if you're looking for a trade as per my strategy that I am going to share with you, that's strategy number 1. If the stop loss for the trade goes above 50 pips, you have to ignore that trade. Ideally, it should be 20 to 30 pips. If your strategy tells you here you should buy or sell, and if the stop loss is above 50 pips, then neglect that trade, ignore that trade. But if that is 50 pip or below 50 pip, like 20 to 30 pip as stop loss, then you can apply that strategy and trade on that strategy. So that's very important. Okay, now let's move on. The broker, you should use XZTrader. We use volumes of XZTraders. On mobile, you can open a demo account of XZTrader and XZUS03 demo. You can search this server and you can open a demo account, and you will use these tick volumes which we will use. You will use the broker XZTrader. Okay, this is the MT4 of desktop version and this is the MT4 of mobile version. You can use both. Okay, so we have to read these volumes, and especially the ultra high volume which I discussed in my previous lecture. So this strategy is wholly based on reading the volumes. Okay, now let's move on to this strategy. Strategy is if market drops like this red candle. If market drops like this red candle, market drop, but there is an ultra high volume, a volume which is greater than previous. This is a 5 minute chart. This is a 5 minute chart of Oanda broker, and here you see that there is a ultra high volume which is greater than previous, greater or comparable with previous few scenarios. And then when market goes down, the next candle also is a bearish candle, and there is an ultra high volume in it. Now wait for market to reverse in a bullish candle. When market reverse in a bullish candle, you just look at the volume of that candle. If the volume of that candle is low, you should buy there. Okay, that's called the two candle scenario, and that's the strategy. Strategy is when you see two candles, red candles, whenever you see two red candles, volatile candles, red volatile candles, which an ultra high volume, to volume that is bigger than previous few volumes, extraordinary volume, spiky volume, then you have to wait for the market to to reverse. And when market reverse, wait for one bullish candle. When one bullish candle comes in, you just check it, the volume of that candle. If that volume is less than those volumes which appeared on these red candles, then you should go for the buying opportunity. You should buy here. You should buy on the candle closing here. You should put stop loss below, and you should expect 1:3, 1:5, 1:10. That is the strategy. Okay. Strategy. Basically, what happened is, when market dropped in a sell candles, then what happened, then the traders were panic, the retail traders were panic at that situation, and the players were buying at that situation. And when players start buying in a red candle, the supply coming from the retail traders is actually absorbed by the demand of players, big players, smart money. And when smart money has enough buying, so that the trend started to reverse, then that means that there is clear imbalance of supply and demand, and now demand is more overruling supply. Now you should wait for one bullish candle, and bullish candle should have a low volume than previous players activity. The bullish candle which is reversing against this professional activity, within this professional activity, high volume activity, the bullish candle should have a average to low volume. That's very important. And when that's closed, you shall buy here on closing. You should put stop loss below that, and you should expect 3:4, 1:3, 1:4, 1:5 after that. So that is the strategy. And look, trend is bullish. Trend is so that trade is within the trend. We are trading within the trend, and that works perfectly in any market, especially on gold. So this is a 5-minute chart, and this is the scenario which I am explained you. Okay, and that's called the two candle scenario, where on both candles there's an ultra high volume. You have to wait for the players to buy enough so that they can reverse this trend towards upside. When the trend reverse to the upside, the candle which form is of low volume. Why this is low volume? Because the market maker at this situation, in the market there are market makers. Okay, and the market makers know that previously on the drop smart money is buying. So market maker actually what does that, they remove the sell liquidity. They remove their sell liquidity because they are clearly expecting that previously players are buying on these sell candles. So the market maker are very smart as well. They watch these type of activity of smart money, so they remove their liquidity. When they remove their liquidity, market start moving up with low volume, because there is no sell orders in front of them, as market maker is watching this situation and responding to that situation. And when the market maker responding to that situation, when the market maker know that players are actually buying, and players are actually trying to building up a buy position, and market will go up. So that market maker will have pending sell orders and buy orders. Below they have buy orders, and above they have sell orders. They're providing the liquidity, so they remove the sell liquidity because they know that market will go up and they will sell at higher places as well. So they know, and that is why this bullish candle have a low volume. So when you see a low volume bullish candle after a two sell candle, ultra high volume sell candle, that is the setup, and you should buy there. You should place stop loss below, and you should expect a 1:3, 1:5 in that scenario. That is the strategy number one. This is called a two candle strategy. I will explain in other next. There is a 3 candle, there is a 4 candle. Now these are the volumes which are same in color. You can use any volume. For I using this bar volume. Let me explain to you how I conclude bar volume. Come to the trading view, and you open indicator volume. Okay, you will get this volume. Just go to volume setting. Just do that. It is a column. You should place it as a histogram. That's a histogram. You should color it as a black, and both color growing and falling as black. and you should select this bold line. Okay, bold line for both. Okay, now that's exactly which I am explaining. So you get these type of volumes within histogram, this type of volume. Okay, these are the these are the these are actually histograms. Okay, so you have a histogram type of volume coming on in front of you. So the slides I am using is histogram volume. Okay, so next again, you are watching the market trend is over, a trend is bullish. I mean, this is a 15-minute chart of Wanda Gold. We are trading watching gold. This is a Wanda broker, and market is very bullish, and suddenly market a news came in. Suddenly there was an economic in the economic calendar, there was USD news. Suddenly market dropped reacting that news. When market dropped, the reacting that news, what retail traders do, they sell by watching the news, and news is very bad, sell. When they sell, player actually buy, as player have this habit of buying against the sell candles. Okay, I explained this all phenomena in my previous lecture 8. I explained all that. Okay, you can watch that out. That player always buy on sell candles. So when markets drop suddenly, then retails got panic, they sold their buy position or they activated their sell positions, and when they activated their sell or sold their buy, the player was actually buying in front of them, and player buy too enough that market start going up. Now when market start going up, this bullish candle form, check out this volume is very low. If volume is almost half of the previous ultra high volume, that is okay. If volume of buy candle is almost half of the previous ultra high volumes, then that is okay. So these are the three candles which are having a ultra high volume. Look at the volume is greater than previous all activity, day activity. This next volume is also, if we compare it with previous all day activity, that is high. So three ultra high volumes on three ultra high candles. What player is doing, player is buying in front of these sell candles, and player is buying, and now player have enough buy, so that market demand is now overruling. And when in market have an imbalance of supply and demand, like the demand is more and supply is over, now market start drifting upside, and when market start drifting upside, market bullish candle. When market form the bullish candle, check it volume is half of the ultra high volumes and at least low volume, then you should buy there. You should place stop loss below. You should buy this trade, and you should expect 1:3, 1:4, 1:5. That is the strategy. Okay, now let's come to another chart. Again, there is an uptrend. This is a gold chart, 15-minute chart of Wanda, a broker. A market suddenly came down on two candle scenario. Previous was the three candle scenario. That was a three candle scenario, three ultra high volume. Now this is the two candle scenario. There is a clear cut ultra high volume on both sell candles. That means player is actually buying at this place and wait for market to turn reverse in bullish candles. When markets reverse in bullish candle, then check out the volume is normal to low. That means market has a strong imbalance of supply and demand is more than the supply. Now market maker is watching that closely, the activity of players, and when market maker see that a player is buying on sell candles, they actually remove their liquidity. They actually remove their sell liquidity. When they remove their sell activity, market easily go up without volume, in low volume. So that means that you have to buy there, you have to put stop loss there. We expect 1:3 from there. Same case was there. Look at the volume of bullish candle, low volume. That means market makers are watching our situation. Market makers know that what players are doing in the negative news. The market maker actually remove their sell orders liquidity. market makers are actually providing the liquidity of to the traders, to the market as well. So when they saw that the market conditions are bullish, they remove their liquidity of sell liquidity, and when they remove their sell liquidity, market bullish candle have a less power to go up, and less power means they require less volume to go up. And that is why you buy this whole phenomena is saying that market is going from there towards upside. So you have to wait for one bullish candle, low volume bullish candle, and whenever you get a low volume bullish candle, you should buy there, you should place stop loss below, and you should expect 1:3. Same case here, you again low volume bullish candle, you should place you should buy there, you should place stop loss below that, below bullish candle, you should expect 1:3, and that happened here as well. Again again same scenario. This is the 30-minute chart of Wanda. Check out sudden big volumes which are greater than previous all history, near-term history of near-term volumes. These are the massive volume. Maybe some bad news came in and market suddenly dropped down. Market suddenly dropped down. Retail traders, smart trader, weak holders got panic. They sell. But the smart money knows the major direction. The smart money knows that gold is very bullish, so they bought. In terms of retail traders were selling, the players were buying, and the price was drifting down. Suddenly price stopped because players were buying, so players bought too enough that trend actually stopped. Now market makers, what they do, they know the market very well, market makers as well, because they are watching the screen closely, that they have a best data in front of them. They are watching that big buy orders are coming in front of this drop, so they actually remove their sell liquidity because they are also expecting market to go up. So they remove their sell activity, and market when turned towards upside, check the bullish candle, low volume on bullish candle. That low volume or bullish candle, which is volume is less of over half of the ultra high volume, indicates that market have a clear imbalance of supply and demand. Market have a more demand than supply. Demand is actually over dominated the supply, and now market is clearly going up and there is no resistance. This low volume jump mean there is no resistance to the upside, and when there is no resistance to the upside, then less power is needed to throw it towards the upside. So market will ultimately slowly going up. So you have to wait for the one bullish candle which is of a low volume. You should buy there, you should place stop loss below, and you should expect 1:3, 1:4, 1:5 trade will give you profit. That is the strategy. Ultimately the bigger time frame of gold is bullish, so we are trading within the trend. Okay, again trend is very bullish, and suddenly market is doing consolidation. Suddenly some news came in. This is a 1 hourly chart of Wanda Gold, and on these three candles, sell candles, one is doji type or nothing, indecisive candle, but these three candles, there are three candle scenario. The volume is ultra high volume, and then market start reverse in a bullish candle. There is a low volume. Again market makers are very watching the market. They know that these previous three candles players were buying enough that they turned the market from bearish to bullish. They are now ready to break up from this consolidation, and now you can place a buy here, you can place a stop loss at low, and you can expect 1:3, 1:5, 1:8. So what on you target you expect, you can expect profits on that type of trade. Okay, on sell candles, player buy when there is a ultra high volume which is greater than the previous 10 to 15 candles. Like in 1H we compare with previous 10 bars, and previous 10 bar this volume is very high. So you just wait to one bullish candle after this ultra high volume scenario to close, and when they close you should check the volume. If it is half of the previous ultra high volumes, you should buy there, you should place stop loss below, and you should expect 1:4, 1:5, 1:7 activity. Again too much buy scenarios. Again market suddenly drop. This is a 1 hourly chart of gold. Market suddenly drop. There is a clear ultra high volume on these two candles. Maybe some news came in, then wait for market to turn back. Market turn back with a small bullish candle. They'll check the volume ultra low, very low volume. That means that the market makers are actually responding to the market. They know that players were buying at that place, so market maker actually removed their sell sell orders, and when their market removed sell order, market gone up. Again there was another setup. There was another setup at that same sport. At sport level there was another setup. There's at this setup there was ultra high volume of 3 candle scenario on 3. Look at the volume, 1 2 3, ultra high volume, which is greater than previous 7 to 10 volumes. Now on these 3 candles there is a ultra high volume. Wait for candle to reverse. That reverse candle is a buy candle with a low volume, means players, the market makers knows that players were buying at this place, so market maker removed their sell activity, their sell orders, and when they remove their sell orders, green candle formed with low volume because they have no resistance to the upside. The upper sell orders were removed from the market player, so market will easily go towards the upside because overall in the background there was too much buying there. So market maker knows that he will get a higher rate, so he will sell his holding on the higher rates. So he actually sold, he actually removed his sell liquidity from there. So market ultimately turned up and going up, and you got the 1:3, 1:4 very easily. So that is the strategy. Again, that is a chart of Bitcoin. That is a 30-minute chart. This strategy works on Bitcoin as well. You check it out. Where market is going down, suddenly big volumes coming into the market. These volumes are bigger than the previous whole day volumes. Okay, these are the ultra high volumes. This is a 3 candle scenario. On 3 candles, this is a box, ultra high volume box where 3 candles have an ultra high volume. Then market, and what's happening there, actually smart trader, big players are actually buying and sell candles. When they buy and sell candles, then market when they too much buy say on sell candles, then market start going up slowly, reversing up slowly in buy candle. Check the volume is very low, means market maker is actually knows the story as well. They actually watching the closely the market condition, and market condition are there is that players are actually buying. So the market maker actually remove his sell orders or sell liquidity so that they can sell at higher place. So they remove their sell activity, means there is a clear imbalance shift of from demand is overruling supply, and there is completely imbalance of demand and supply, where demand is very much and supply is almost nothing in front of it. So there is no resistance to the upside, and when there is no resistance to the upside, market has to go up. So that is the buying level. Wait for one buy candle with low volume. When you see one buy candle with low volume, buy there on buy candle closing and place stop loss below and expect a magic 1:3, 1:4, 1:5. That is this strategy. You just need to buy after one buy candle close with low volume. That's it. Again, that we talked too much about the bullish scenarios. Now let's come to the bearish scenario. Now if you have a previous resistance to the left, and if market have a bullish candle breaking out this resistance, and if the bullish candle, both bullish candle have a ultra high volume, the two volumes are bigger than the previous 10 to 15 bars. This is a 1 hourly chart of Bitcoin, and the volume is clearly bigger than previous 10 to 15 candles. Very clear. So this is a ultra high volume. When market breakouts its resistance with an ultra high volume, it's mostly a fake out. It is not a real breakout, it is a fake out. Whenever market breaks the resistance with an ultra high volume, it is a fake out. There is a 90% chance that that's a fake out. And when you see a 2 candle buy candle with an ultra high volume, that means that the retailers are actually buying on the breakout, because they know that price actually break out from this resistance level, and now retail traders what they do, they buy. When they activate their buy position, the player is very active there. Player actually sell their position in front of them, and when players they sell their position, as players do, big players, smart money actually always sell in buy candles. And when they see such type of behavior of retail traders buying on breakouts, they actually use that scenario and sell. Wait for one sell candle with low volume. Here is the one sell candle with low volume is very low in compared to the ultra high volume. That means that there is no now real supply, there is no real demand, and there is less power to go needed to go downside, and the market maker are also watching this all condition, and market maker now are removing their buy liquidities. On previous situation they were removing their sell liquidity, so market goes up. Now their market is expected to go down, so they are removing their buy orders. Okay, they are removing their buy orders. So when they remove their buy orders, market has little force to go down. That's why this low volume came in, and that is the indication that market will going down. So after that, market collapsed. You got the 1:3, 1:4. Sometime market collapse directly, sometime market start ranging, and then ultimately collapse. Okay, that is the strategy. Okay, now this is the chart, Bitcoin chart of 1 hourly chart. You see the green candles, three green candles with an ultra high volume, which is greater than previous 1 to 2 days even. Okay, previous whole day or 2 days even. So these ultra high volume, maybe some news came in, where good news came in, and the retail traders are actually buy. What smart money is doing, they are actually selling in this steep jump. They are selling on every candle. Wait for one candle to reverse. When one candle goes reverse, check it volume. If low, sell it. Sell on this sell candle. Place stop loss below and make big profit. 1:3, 1:4, 1:5. That's it. Because players were actually selling on this buy candles, and when players were selling on this buy candle, when market start reversing, then market makers know that actually market will go down. They actually remove their buy liquidity. When they remove their buy liquidity, the sell candle have lower force to go down, and the volume is actually evident there that that's a low volume, means market is going down with the low volume, means there is no real pressure to the upside. Market has to ultimately go down, because on lower side there is no resistance. What is the resistance means buyers. There are no buyers into the lower prices. When there are no buyers to the lower prices, then the supply is basically overcoming the demand, and supply will drift it down. So supply actually taken all these to the downside. So whenever you see a 3 or 2 buy candles with an ultra high volume, wait for one sell candle with low volume, then sell it. That is the strategy. Okay, you will get 1:3, 1:4, 1:5, whatever you can manage the trade. Again, this is a USD JPY chart, USD dollar Japanese yen chart, 1 hourly chart, and suddenly good news came in with 3 bullish candles, and maybe some news came in, and then there is ultra high volume on all 3 candles. Then wait for market to reverse one sell candle. When one sell candle came in, check out the volume. If volume is half of the ultra high volume, that means that you have to sell there. You have to place stop loss above that. You have to sell there and expect a magic drop and get major profits. 1:3, 1:5, 1:8. That's the strategy. Okay, that's the strategy. Because on jump, maybe good news, retail traders were buying, big players or smart money is actually selling in front of them, and ultimately too much selling from the smart money, markets start drifting down. When started drifting down, this made the sell candle have the low volume, means the market maker is actually know this situation. They are removing their buy orders, buy liquidity. That is why there is no resistance left in to the downside, and market start drifting down. There is another example of sell. Again, there is a previous resistance area, there is a level to the left side. This is a resistance level. Market start a breakout of market gave the breakout of that previous level with an ultra high volume. That's always a fake out, because any breakout with an ultra high volume, whether it break down or whether it break out, that is a fake out. Wait for market to turn back. One sell candle with a low volume is enough for you to sell. Place button of sell, trade it, and place a stop loss above that, and just expect 1:3, 1:4, 1:5 after that trade. So that's very important, that in two buy candles, what retail traders does, retail traders were actually selling at this resistance level, and when they were selling at this resistance level, they actually bought at this breakout level, retail traders, because that area actually breakout. Now when they bought, the players actually were selling in front of them. Maybe some news came in, that's why. So on good news, the retail traders were buying, and the big players know the bigger picture. They know the market is really weak. This is a temporary jump, so they sold their position in front of these retail buying, and the market now has an imbalance of due to that. What imbalance is that? Now supply is overcoming demand, supply is more, demand is less, so market turned back. And when the market turned back, there is a sell candle with a low volume, means that market maker actually market maker actually cancelled their buy liquidity, and when they cancel their buy activity, there is no resistance to the downside, so market has to go down and you have to sell it here. You have to place stop loss here. You wait for one sell candle and then sell, place stop loss on above, and then expect a huge drop. That's the strategy. This is the strategy number one. This is 2 candle scenario, 3 candle scenario, or 5 candle scenario. These are the scenarios. Either it will be your 2 candle scenario, ultra high volume on 2 candles, either there will be ultra high volume on 3 candles, either there will be ultra high volume on 5 candles. This is the setup: 2, 3, 5. Okay, again there is an support onto the left, and market actually break that support with an ultra high volume. I already told you, whenever there is a support or resistance breakout or breakdown with an ultra high volume, is a fake out. So market is actually does that. This is a fake breakdown, and then market start going up and come above the support value. And look at the buy candle with a low volume, clearly suggesting that market makers are actually getting market makers remove their sell liquidity from there, because they know that these 2 buy candles have an professional activity. Have institutional traders or big traders or big money or smart money was buying at this place. So market makers were watching the markets. They react as per the condition, and they remove their buy sell orders in front of them, and that is why the buy candle is getting a low volume, because there is no resistance to the upside. Now market is going up. You have to buy after this buy candle, and you have to place stop loss below, and you have to expect a 1:3, 1:4, 1:5. Again, in this chart, 2 scenarios. This is a sport, this is a trend. Never trade against trend in oil. This is a tip: never trade against trend in oil. Always trade within the trend in oil. Oil is very tricky. There's a 1 hourly chart of crude oil. Okay, previously we were also have a 5-minute chart of crude oil, and I will explain all the scenario. Now we have a crude oil 1 hourly chart, and there is a 3 candle with an ultra high volume. It means smart money is buying there and wait for 1 buy candle with the low volume. If 1 buy candle came in with the low volume, just buy there, place stop loss below. This setup is perfectly fitting at this support level as well. Now place the stop loss at below and expect 1:3. You got the 1:3, 1:4. Now again market drop, and again there is an ultra high volume which is bigger than previous 7 to 10 volumes. Here also volume which is bigger than previous 7 to 10 volumes, because this is in 1H time frame. So wait for 1 bullish candle to reverse. Check it the volume. If volume is lower than previous ultra high volume, then buy there, place stop loss below, and expect 1:3, 1:4. So that's very simple strategy. This is the chart of Euro USD 1 hourly chart. Look at this is the previous support area. Price came down with an ultra high volume, break this support level as well. And if that is on a ultra high volume, that is mean this breakdown is a fake breakdown. Market now start consolidating and going up. You have to wait for 1 bullish candle with low volume. 1 bullish candle with low volume means you have to buy there, place a buy on front of buy there, place stop loss on low, and expect 1:3, 1:4 or major reversal. Okay, players were actually buying on these three ultra high volumes. Players were buying, the retail traders were selling, because the sudden drop actually comes from the news, maybe bad news came in. So on that bad news, retail were the sellers, the players were the buyers against them, and due to that, this whole downtrend start reversed. Remember, if the chart is one hourly chart, you can go against trend as well. In 1H time frame, you can also trade in trend reversal side. Always you try to trade in within the trend. That's very important. But if you want to trade against the bigger trend, then you should have a setup of one hourly chart. Okay, that's very important. Again, there is previous resistance, market start going up and breakout with an ultra high volume on all three candles, buy candles, clearly suggesting that that is a fake out. And on these three buy candles, retail traders are buying. Possibly maybe some economic calendar news came in, which is very positive for GBP USD. This is a 5-minute chart, and this three candle scenario have a ultra high volume. Wait for one sell candle to reverse within a low volume. When that reverse within low volume, sell here, place stop loss above, and expect a major reversal. And that's what happened. Okay, you know that market maker is actually watching this closely, and they actually remove their buy position, because they know that that jump was actually the not a real jump. That was a fake out jump, because players were buying against those big buy orders that was coming from the retail traders. And when market came reversed, when there is imbalance of supply and demand, supply is overruling demand, and so a market maker reacted to this situation. They removed their buy orders, and markets now suddenly dropped more easily, because they have no resistance to the downside. Okay, so that's the strategy. Again, there is a previous resistance, market have a very good news. These big buy candles actually comes in a very good on news time. So market have a very big news coming. This strategy basically more works on news as well. Just wait for news and trade after 5 minutes after news. You will see my strategy, this strategy. This is a USD CAD chart of 15 minutes, and you see that there was a good news on maybe USD, or bad news for the CAD, and the market start jumped very aggressively. There was a ultra high volume on all these two candles, means the market the retail traders are buying, and market players are selling, big players are selling. And wait for one sell candle. When one candle came in, check it the volume of the sell candle. If that is low, that means the market is actually reversed. Sometime market take 1 to 2 extra candle to reverse, but wait for market to reverse. When market reversed, you simply sell there and place stop loss above, and then expect 1:3, 1:4. So that's very powerful strategy. And candle scenario may be 2 3 5 2 3 5. These are the candle scenario, either 2 candle scenario, or 3 candle scenario, or 5 candle scenario. Again, volume, market is dropping, volume is low, means the market players actually reacting to the market condition, and they remove their buy orders, so that market is easily going down with no resistance to the downside. So mean market will go major big down. Again, this is the AUD USD chart, Australian dollar chart. This is a 30-minute chart. There is a clearly bullish trend in the background. Suddenly bad news came in, and on all 4 candles. Okay, the candle scenario can be 2 3 4 5. That's it. 2 3 4 5. That's it. Okay, here these are 4 candles with an ultra high volume. Check it out. Ultra high volume on all 4 candles. Maybe some new drop on news. Now wait for one buy candle to reverse with the low volume, and that happened. Buy their stop loss place below, and expect 1:3, 1:4. So here what happened, market makers were reacting to the situation. They know that big players are actually buying on these sell candles, and market has to go up from somewhere. When market turned back, they actually cancelled their all pending sell orders, means they removed their liquidity of sell liquidity. And when they removed their sell liquidity, there was a low volume of bullish candle, and when there was a low volume bullish candle, market maker reacted the situation. So you have to also buy there. You have to place stop loss below, and you have to expect 1:10, 1:5, whatever you want. Because in my if I give you 1:2, 1:3 type trade, that's enough for you. You don't need any 1:10, 1:8. If you are getting 1:2 or 1:3, that's also enough. Okay, so make sure that your stop loss should be below 50 pips. If your stop loss is having like more than 50 pips, then ignore that trade. Again, this is a New Zealand USD chart, and market is going up with a massive volume, massive volume. This is a 1 minute chart. This strategy works on all time frame. This is a 1 minute chart. If you are trading in a 1 minute chart, you should trade on Asian session. I don't recommend to trade on UK or US session. If you are trading on a 1 minute chart, you have to trade it on Asian session. And there you see that there ultra high volume, then market start going down with a low volume. So that is clearly suggesting that there was clearly selling going on there with an ultra high volume, and suddenly market start going down. You have to sell there, you have to place stop loss above, maybe 5 pip, 10 pip SL, and you got a nice drop. Okay, very nice drop of maybe 31. You can draw, you have a 5 pip of stop loss, you got almost 5 to 20 pips drop. So 1:4 came in. So that is a powerful strategy. Okay, in 1 minute you always try to trade within the trend is down. Overall New Zealand USD trend is down. Thank you. That is the strategy, and I told you everything in it, and that is the strategy number 1. So thank you. If you have any question, you can email me, and also in email you should also mention your phone number as well. Thank you.